Hello friends, now let us focus on our next subtopic where the discussion will be all about your export promotion schemes, and to be very specific, the first part of the discussion of export promotion scheme will be on your advance authorization and duty free import authorization, which is nothing but your chapter 4 of your foreign trade policy, and when you talk about handbook of procedures volume 1. Right, so our discussion is now restricted to your chapter 4 of foreign trade policy issued by your Ministry of Commerce and Industry, that is central government, and handbook of procedures volume 1, same corresponding chapter, same chapter 4, handbook of procedures volume 1 issued by DGFT. The difference is chapter 4 of FTP issued by government will talk about the policy, and chapter 4 of your handbook of procedure volume 1 will talk about the procedures related to same advance authorization and duty free import authorization. Right, and a very important concept when you talk about your advance authorization, duty free import authorization, a lot of times differences have been asked, and even only if you conceptually understand the same with the flow charts, only the things will settle. Now before we actually start with advance authorization and duty free authorization, duty free import authorization, let us discuss about this topic called as export promotion schemes. Friends, we are talking about your export promotion schemes. Export promotion scheme. Now, export promotion scheme are of two types. One, when you are talking about duty remission scheme, I am writing it as DRS, and one is duty exemption scheme. Your export promotion schemes are of two types when you talk about duty remission scheme and your duty exemption scheme. Friends, your duty remission scheme we have discussed there in your Customs Act and your GST. So that discussion about your duty remission scheme was there in your GST law and customs. You already discussed it, we will just revise a bit and we will move on to the duty exemption scheme which is given in your foreign trade policy. So this first you have to understand, we are discussing about export promotion schemes which can be categorized into two. One, friends, which you are calling it as your duty remission scheme, other which you are calling it as duty exemption scheme. Duty exemption scheme. Now friends, this duty remission scheme is a scenario where you are talking about after your export you get the benefit. So this duty remission scheme benefit is post export. Post export, and duty exemption scheme is benefit is pre export. The benefit you get is before your export. Right. So duty remission is asking the refund or rebate. Duty exemption scheme is you don't pay any import duty, therefore there is no question of any refund or rebate. So it is pre export. Pre-export, the way they operate is different, and the most important difference that, friends, I want you to understand, if you look at things beautifully, you will find that all the three laws connected, your GST law, customs law and foreign trade policy, and friends, everything is the policy matters of import and export is always decided by your foreign trade policy. So foreign trade policy tells that you have duty remission scheme for which you have to follow the procedures given in your GST and customs, and you have your duty exemption scheme where you have the policies in your foreign trade policy that will also be read along with your GST and customs, so no doubt. But here the matters are discussed directly in foreign trade policy. Right, the difference is your duty remission scheme is after your export and the exemption scheme is before your export. To make things very clear, if I am talking about your duty remission scheme, I am talking about a scenario where you import and then you export. You import, you pay import duty. You import, you pay import duty. Then you export, you get the refund. Right. So friends, you are talking about the first of such practices, the first of such scenario. You are importing the goods, paying import duty, right. Then friends, you are exporting the goods. That is an import followed by export. So you are importing the goods or raw materials, paying import duty, then you are doing manufacturing in India. So in India, friends, there is manufacture, so that you have to remember. Then you are exporting. Friends, Even if there is no manufacture, duty drawback will always be there, because there are two types of duty drawback: section 74 duty drawback, section 75 duty drawback, right? And here friends, you get duty drawback. Duty drawback, that is given in your customs. That is given in your customs. That is the first type, right? This is the first benefit. And friends, there is a second benefit where you purchase the goods from within India. You purchase the goods from within India. So that purchase is from within India, then you are exporting after manufacture. So now it is a supply. Within India means I am writing it as supply, and then you may manufacture, you may not manufacture, but I am talking about a general scenario in FTP, which is manufacture, then you are exporting. So this manufacture is not always required, but I am talking about the general scenario because I have to compare this with your foreign trade policy. So friends, when you are doing that, on your purchases, you have GST, CGST, SGST or IGST as the case may be. When you export, right, also then you have your GST, but what you do, you have two options. IGST will be there. Specifically when you are talking about export, you have two options, IGST. First option is friends, pay IGST, output IGST to be very specific, pay output IGST, and thereafter claim the refund of output IGST. That is the first option, payment option, which we have discussed in your GST called as payment option. Second option, don't pay output IGST, don't pay your output IGST, because you are talking about your bond or LUT, you are going under bond or letter of undertaking, and claim the refund of input tax credit of your inputs and input services. Claim the refund of input tax credit, that is your GST on your purchases of your inputs and input services. So these things we have already discussed. And when you talk about duty drawback, friends, we have discussed it is either section 74 duty drawback if it is a trader, and we are not talking about manufacturing activity, section 75 duty drawback. Friends, what we can easily understand from these points, if you look at these points, we can easily understand or make out a conclusion from these points, is here we are talking about post export benefit. After export, you are getting something. Yeah, it's all about refund. Duty drawback is nothing but refund of import duty. Duty drawback is nothing but refund of import duty. So it's everything is all about your refund. Everything is all about your refund. Now, if you have seen the first scenario carefully, what is happening in the first scenario is you are talking about you're importing your raw materials, paying import duty, right? Normally used for manufacture. In certain cases, it may not be used for manufacture. Section 74 duty drawback is applicable even for a trader. When you export, after you export, you go for duty drawback. Section 74 duty drawback is for a trader, no processing at all. Section 75 drawback is for a manufacturer. It is for a manufacturer where you have done some processing or actually manufacturing. Even if the process is not amounting to manufacturing, it is section 75 that we have discussed thoroughly in your customs. Or in GST, see, it may happen that not all your raw materials are imported. Few materials may be purchased from within India. So you are talking about that, rather both will be combined. In practical scenario, both will be combined. Both will not separately. Both will be combined because few of your raw materials will be purchased from within India. So on that, GST would have been suffered because they were purchased from within India, right? And thereafter you export your final product. So you have to combine both first and second scenario. Now friends, this export will have output IGST, right? And for your imported raw materials, you get duty drawback. For your domestic raw materials, you have two options. First pay output IGST. First pay your output IGST. Then go for the refund of your output IGST. So first pay your output IGST. Then go for the refund of your output IGST. Or don't pay output IGST, go under bond or letter of undertaking, then claim the refund of your input tax credit on inputs and input services. Friends, The first part we have discussed in your customs, and the second part, friends, we have discussed in your GST. We have discussed that in your GST. So I'm not going to tell that. I mean, duty drawback, when you talk about section 75 duty drawback, obviously you're talking about your all industry rate, brand rate, special brand rate, etc. Because the focus is only on manufacture. Section 74 drawback, we are not taking much, because here the focus is much on manufacture when you compare with your foreign trade policy. It is all industry rate, brand rate, special brand rate, etc. So we have already discussed that in your customs. Right. Now friends, in your foreign trade policy, they talk about duty exemption scheme. They talk about your duty exemption scheme, where they tell that you import the raw materials, don't pay import duty on your inputs, import of your inputs, don't pay import duty, manufacture your final product, and thereafter you export, and if you export, there's no question of any duty drawback, because I have not paid any import duty. Now friends, this is happening under your advance authorization, but there is an export obligation. As you are not paying your import duty, against advance authorization. Friends, this concept is all in your advance authorization or duty free import authorization. Both are for inputs. So what is happening, friends? Here you are talking about a scenario where you have imported your inputs, not capital goods, inputs. You are not paying import duty, therefore in the beginning itself you are not paying import duty, there is no question of duty drawback. So when you are not paying import duty, there is no duty drawback. Duty drawback is refund of import duty. When you have not paid, there is no question of duty drawback. You are talking about your export obligation to be discharged. You have to promise some exports. So there will be bond or bank guarantee. Right? How this is happening, friends? This is happening by way of your advance authorization or duty free import authorization. Which is for inputs. Now friends, this import can also be of capital goods. So you are importing capital goods, manufacturing in India and exporting the final product. So export is only of final product. In both the cases, export is only of final product. So we are not changing that. But if you understand that even for manufacturing final product, you require both inputs as well as capital goods. So your advance authorization or duty free import authorization is for your inputs, raw materials. Now your export promotion capital goods scheme is for your capital goods. So you are importing capital goods, not paying any import duty, using it for manufacture of final product, exporting the final product. Now when you are exporting the final product, obviously when you are not paying import duty, you have to promise some exports, export obligation. Export obligation you have to take. So if you look at this scenario, friends, you are talking about import now of your capital goods. Even on your capital goods, you are not paying any import duty. Now friends, it is not advance authorization or duty free import authorization. A corresponding provision for your capital goods which works in the same manner like your advance authorization or duty free import authorization is export promotion capital goods scheme. So your advance authorization, duty free import authorization is for your inputs, and your EPCG, export promotion capital goods scheme, is for your capital goods. But the concept of functioning of both are exactly the same. So you import inputs, don't pay import duty against advance authorization or duty free import authorization, promise some export obligation. Right? You import capital goods, don't pay capital goods under EPCG scheme. You promise some export, because as an when you are not paying import duty, you have to promise some export, that is export obligation. You promise some export, that is nothing but your export obligation. You promise export of final product, your export obligation. Because you are not paying any import duty on your capital goods, you have to promise certain exports of final product which are going to be manufactured using those capital goods. Right? And friends, both these schemes are there under your foreign trade policy. So you are talking about your foreign trade policy. So if you look at things very carefully, right, if you are talking about duty remission, refund, duty remission, you are talking about refund. Remission means you are talking about your refund. Pay import duty or GST, then go for refund. Here, duty exemption scheme, you don't pay import duty, or rather you are focusing only on import duty, not on your local purchases. You don't pay import duty, there is no need of any refund. There is no need of any refund. Now, if you look at things carefully, duty remission scheme, refund scheme is all covered under your customs when you talk about import of raw materials, GST when you talk about local purchase of raw materials within India, right. So one aspect, duty drawback, we have discussed in your customs, specifically section 75 duty drawback, because you are talking about manufacturing, all industry rate, brand rate, special brand rate. The other aspect is when you purchase few raw materials within India, it will all happen together, it will not happen separately. When you purchase few raw materials together, you are working, I mean you would have paid, it would have suffered GST on your purchases. And when you export your final product, you have two options. One option, pay output IGST, take the refund of pay output IGST using your credit or cash, and take the refund of entire output IGST, whether paid by credit or cash, right. Second option, don't pay output IGST on your export, claim the refund of input tax credit on your inputs and input services. So that friends you have to understand. So this concept you have to understand it very clearly. Why you are not paying your output IGST? Because it is under bond or letter of undertaking, and you get refund of input tax credit of inputs and input services. And when you talk about your foreign trade policy, they give a better solution, but it is only related to import, not your local purchases. They tell that if you have imported inputs, import it against advance authorization or advance authorization or duty free import authorization. Don't pay import duty on your inputs. You use it for manufacture of a final product and export it. When you are not paying import duty on inputs, there is no question of any refund. But yes, when you go for your advance authorization or duty free import authorization for your inputs where you are not paying any import duty, you have to promise certain export obligation. Likewise, if you import capital goods, and if you don't pay any import duty on capital goods because you are going under EPCG scheme, then friends, again, you are importing capital goods, not paying any import duty on your capital goods because of your EPCG scheme, but when you are exporting, you have to promise certain export obligations. The moment you import, you have to promise certain export obligation that I am going to export so much of amount of value of a final product. So that export obligation has to be taken. And when you have not paid import duty, friends, there is no question of any export, there's no question of any duty drawback. Obviously, export obligations are, but there's no question of any duty drawback. Friends, all these things actually will happen together. So, though we have seen things separately, they will actually operate in practical scenario. Everything can work together. All these things can work together. To make you understand that, I'm merging everything into when you talk about all the aspects that we have discussed. Now, what will happen is, we'll take a bigger picture. I'm merging all things because now you are clear with all these duty remission scheme that we have discussed in GST and customs, and fairly you have a basic idea of your duty exemption scheme, your advance authorization and duty free import authorization, right. You are talking about your final product, and you have used some inputs, capital goods, even input services, inputs, capital goods, including input services for manufacturing your final product, which is exported, say which is exported to USA. So that is export of final product. And what you have done in India is manufacturing. So we are focusing on manufacturing, right. Now friends, you have to understand that certain inputs and capital goods, let us not focus on input services because it will always attract GST. It will always attract GST. So certain inputs and capital goods, say input 1, capital goods 1, right, they are imported. inputs 2, rather I'll take it together, inputs 1, capital goods 1. Inputs 2, capital goods 2, they are also imported, but import duty has been suffered. Input 3, capital goods 3, and your input services, all your input services. So I am taking even input services, whether from India or outside India. So input service can be from India or outside India. It has suffered GST. So when you talk about your inputs 1 and capital goods 1, it is import. Inputs 2 and capital goods 2, it is import. Inputs 3 and capital goods 3. Inputs 3 and capital goods 3. It is from within India, and I am writing in bracket your input services can be from India or outside India. It really doesn't make any difference because GST will be suffered. Right. Now friends, this I am writing it as import. This I am writing it as import. This I am writing it as domestic within India. But when I am writing it as domestic, it is only for inputs and capital goods. Your input service can be from India, from outside India. So that is allowed. That will also come under this particular category. Right. Now friends, what is happening is for your inputs 1, capital goods 1, friends, let us assume that you are going for you are paying import duty. If you are paying import duty, correspondingly at the time of export, you will get duty drawback corresponding to this. Only relating to this import duty, you are going to get duty drawback. Section 75 duty drawback. Section 75 duty drawback. Right. And inputs 2, capital goods 2, which is also imported, you are not paying import duty. You are not paying import duty because of the fact that you have gone for your advance authorization, duty free or import authorization for your inputs, or EPCG scheme for your capital goods. When you are not paying any import duty, friends, you have to promise certain export obligations. For duty drawback, there is no export obligation. When you export, you will get the duty drawback. If you don't export, no need to worry. You are not going to get any duty drawback. But here, you have to promise certain export obligations. If you don't achieve that export obligation, the benefit which was given that you are not required to pay import duty, you have to pay import duty with interest and penalty. So that benefit will be taken back. So you are promising certain export obligations. There is no duty drawback, but you are promising certain export obligations. Right. Inputs 3, capital goods 3, which is from within India, and input services which is outside from India or outside India. Outside India is RCM case. It will always have GST. It will always have GST, and always GST will be suffered. So I am pointing GST. It is always has GST, and GST will be suffered. And in relation to that, friends, so I am marking this in a different color. It will always suffer GST. On corresponding to that, on your final product, you are going to pay your final product when it is exported. Even GST provisions will apply, right? So you are going to have output IGST. You are going to have output IGST, where you have two options. Don't pay your output IGST. Pay your output IGST and get the refund of your output IGST, entire amount, whether paid by credit or paid by cash. That is first option. Or option 2, don't pay your output IGST, get the refund of input tax credit of your inputs and input services. So friends, relating to this benefit will be that. So actually everything will work together, right? You are talking about your duty. This first concept was, friends, was all about your duty remission scheme. Input 1, capital goods 1 was nothing but your duty remission scheme under customs, first category, right? The last category was nothing but duty remission scheme under GST, because we have some local inputs and local capital goods, and input service whether from India or from whether imported, same thing. Input services whether from India or imported, it will come under the third category, right? Where it has suffered GST on the inward supplies, that is purchases. Output IGST when you export, it will be two options, either pay output IGST, get the refund of entire output IGST, whether paid by credit or cash ledger, or second option, don't pay output IGST under bond or LUT and get the refund of input tax credit on your corresponding inputs and input services. And even friends, you will have certain inputs and capital goods, that is inputs to capital goods too, where you are not at all paying any import duty, because for inputs you have gone for advance authorization or duty free import authorization. For capital goods you have gone for your EPCG scheme, and when you are not paying any import duty, duty exemption scheme, there is no question of any duty drawback. Duty exemption scheme, which actually works mainly under FTP right along with customs. Mainly it is actually under FTP, but obviously customs notifications are also there for the same, right? Duty exemption scheme. So mainly the working is as per FTP right along with your customs. Everything is actually right along with FTP only. So here it is basically your foreign trade policy which takes care of it. Don't pay any import duty on inputs, go for advance authorization or duty free import authorization. Don't pay any import duty for your capital goods too, go for your EPCG scheme. And no need of duty drawback, but you have to promise certain export obligation. So this actually would be combined. So we have discussed the same thing separately here, this we have discussed together. This is the practical scenario. It will all come together actually. Friends, this was only and only introduction to your export promotion schemes, where you have something called as your duty remission scheme and duty exemption scheme. Duty remission scheme of your customs, that is duty drawback, and of your GST, that is refund. Either refund of output IGST if you have gone for payment option, or refund of input tax credit if you have gone for bond or letter of undertaking. And everything here, all these points here, including your duty remission scheme, is discussed. So this is mere introduction to your export promotion schemes. What we have discussed till now, we have actually not touched upon your advance authorization or duty free import authorization, friends. We have just discussed the introduction of your duty promotion schemes, where we have consolidated the concepts of your GST, customs and foreign trade policy, and beautifully in a chart we have understood how it actually works. Now let us start with your advance authorization. Right, so focus in this subtopic, friends, will be only on your advance authorization, where friends have clearly discussed, we are talking about your inputs to category. If I want to take that example, where we have clearly discussed that you are talking about which scenario, you are talking about importing the inputs, import, it is all about import of inputs to, because in that example, master example, it was input to, correct, where we were talking about your duty exemption scheme. So I will maintain the same thing. You are talking about importing of input to, right? I am just maintaining that example, the master example that we have taken, and using it for manufacture of final product, which is exported. So you have import of inputs, you have export of your final product. And India, what happened, friends? It was manufacturing activity. Whether you paid any import duty on your inputs, no, because you went for your advance authorization. We are not even discussing your duty free import authorization. Once we complete your advance authorization, we'll see the difference between advance authorization and duty free import authorization. Both are for inputs, but there is a small difference when you talk about your advance authorization and duty free import authorization. Now friends, we are talking only about your advance authorization, where you are promising certain export obligations. You are promising certain export obligations. Right, is there any question of duty drawback? No, there is no question of any duty drawback. Why? You did not pay import duty. Friends, we are talking about this scenario. So again, we are just taking that master example, small part, that we have discussed about input 1, capital goods 1, import duty paid, gone for duty drawback under customs. Inputs 2, capital goods 2, duty not paid because of your advance authorization, duty free import authorization or EPCG scheme, but you are promising certain export obligations. Capital goods 3, inputs 3, even all types of input services, whether from India or outside India, GST suffered, and you are talking about refund under GST. Here I am particularly focusing on your input 2, category 2, and that too inputs, category 2 and that too inputs, and that too friends, I am talking only about your advance authorization. As of now we are not talking about duty free import authorization. Finally, once we complete your advance authorization, there will be a differentiation chart to explain the difference between advance authorization and duty free import authorization, which has been the famous or favorite question of ICAI with respect to your foreign trade policy. Differentiate between advance authorization and duty free import authorization, right? So finally we'll discuss that. Now friends, you have to understand that on your import of inputs, it has not suffered any import duty because you have gone for advance authorization. And on your export of final product, you have to promise certain export obligation, which means that you have to satisfy, you have to reach certain export limits. You have to export a particular quantity and a particular value, because you are talking about getting the benefit earlier, exemption scheme. So it is pre-export, you are getting the benefit, so you have to promise certain exports, right? So that is all about the basics of this. And friends, when you talk about your advance authorization, few aspects. Your advance authorization is actual user. It's an authorization, which means that restricted category, you have to take permission, right, from your DGFT. It is based on actual user condition. It is based on actual user condition. That means it is not transferable. It is different from your duty free import authorization because that is transferable, but your advance authorization is not transferable. Your advance authorization is not transferable. It is based on actual user condition, which means that if I have imported that inputs, I have to use it for manufacturing of output. I cannot transfer it to someone else. So it is based on actual user condition. It is not transferable. It is not transferable. Now friends, talking about inputs. So this was about the basics of advance authorization. Talking about what kind of inputs can be there. So you are talking about inputs which will be finally reflected in the final product. The basic raw materials which will be reflected in the final product, right? So you are talking about what all inputs can be there. The basic raw materials which will be finally reflected in your final product, right? A small wastage is allowed. Small wastage which is decided by norms committee will be allowed. So your wastage as per norms committee will be permitted, because you cannot convert the entire quantity of your raw materials into final product. Well, there will be small wastage. That wastage should be within the terms or the procedure set by your norms committee, within the limits of your norms committee, rather than telling terms, within the limits set by norms committee for that particular raw material. Second, you are talking about your fuel or oil or catalyst, which are not actually reflected on the final product, which does not find place in the final product. Say for example, I am talking about the shirt. Fabric is the basic raw material which is actually finding place or which can be reflected in the final product, which can be seen. Buttons, again, it is a raw material which can be seen, right? But when you talk about, say, chalks and threads may be seen, may not be seen, but there are a lot of other items which are consumed, So fuel, oil or catalyst which are actually utilized or consumed during the production or manufacture of final product. So you are talking about fuel, oil or catalyst which are utilized or consumed, And friends, you are talking about mandatory space. Even though this mandatory space will not go into the production process, supposing you are talking about along with the laptop. If I am manufacturing laptop, I am giving the, say, a charger, right? I may not manufacture charger, but it is a mandatory spare. I have purchased a charger from someone else and giving it. I did not use in the manufacturing process of laptop. It was separately purchased from someone else who has manufactured it and given it. So it is a mandatory spare. With a laptop, obviously you should have a charger. So example of mandatory spare is, if I am manufacturer of laptop, the charger is the mandatory spares. Charger is the mandatory spares which is actually given along with the final product, along with your final product, and it should be only up to 10% of total imports. 10% of your total imports, 10% of your CA value. So that mandatory spares cannot be more. Friends, if I am talking about your laptop itself, right? So you are talking about all the raw materials, the outer plastic body or the small metal body or the glass frame or the keyboards, buttons, etc., all the integrated circuits inside, RAM, etc. All these are raw materials. which are actually reflected in the final product. If you open it, you can see it. Normal wastage which is notified by norms committee is allowed. Second, certain fuels, oils and catalysts which actually don't find any place in the final product, but they were actually utilized or consumed. They were actually utilized or consumed during the production process or the manufacture process of the final product. And mandatory spares. Mandatory spares, which means that that spare has to be given along with the final product. You don't have an option. You could not have said that I am not going to give this. Along with the laptop, obviously charger is a mandatory spares which is actually given along with the final product. Why I am telling this particular point? Because when you talk about your raw materials and fuel, oil, catalyst, they are used in production or manufacturing process. This does not goes in production or manufacturing process. Your mandatory spares you are purchased and just given along with the laptop. So you did not manufacture that charger. You buy it or purchase from someone else who has actually manufactured the charger. But that spares value should be less than 10% of CAF value. It should be less than 10% of the imports of the raw material, less than the 10% of the CAF value of all the total imports. So that is the limit of mandatory spares. And friends, the last point is different from all these things because the last point talks about only special cases. So I am not giving it a number 4, though it is actually the number 4, but it is different. It is only for certain things, not for all the manufacturing things. So you are talking about specified spices, right, which are used in manufacture of oil or oleoresins. So it is only for your oils and oleoresins. But when it is allowed, when it is not allowed, it should be used for crushing, grinding, sterilization or manufacture of oil or oleoresins. It should not be used. It should not be used merely for cleaning or repacking. So it should not be used for your cleaning process or repacking process. That is not allowed. Right. So when you talk about the last point, I am writing this separately. The reason being is you are talking about it is only related to a special item, that is you are talking about manufacturing of oil or oleoresins. So it is only talking about a particular industry, and that too that spices should be used only and only in the main process, manufacturing process, that is crushing, grinding, sterilization or manufacture of oil or oleoresins. It should not be used when you talk about your cleaning, repacking, etc. That secondary process, it should not be used. It should be going into the manufacturing process, not as a secondary process. When you are talking about cleaning stuff or when you are talking about repacking stuff, no, that's in that scenario, specified spices is not allowed. Friends, what is the input that we are focusing on? Specified spices. Specified spices. Right, so this point you may not focus much because it is only for a particular industry when specified spices are used in crushing, grinding, sterilization or manufacture of oil or oleoresins. So it is only for a particular industry. Rather, the first 3 points are for all industries. The first 3 points were for all industries. So I have written that specified spices, imports of specified prices as inputs only separately because they are talking about specified spices only if it is used in the manufacturing process or say crushing, grinding, sterilization or manufacturing process of oil or oleoresins. So it is specified sector. The first 3 points are for all the sectors, all the industries. So this point you have to understand. Now friends, we are talking about who should be a manufacturer. I mean, who can go for this advanced authorization. You have to understand that only a manufacturer exporter, only a manufacturer exporter, we will be discussing this in chat, only a manufacturer exporter, or you are talking about merchant exporter who is not manufacturing but who is tied up with a supporting manufacturer. We will discuss that. Only these both can go for your advanced authorization. So who all can go? Strictly speaking, you should be doing manufacturing process, either yourself or indirectly, but you should be tied up, right? So either you are talking about manufacturer exporter directly, or you are talking about merchant exporter who is having tie up with supporting manufacturer, right? Whether service sector, exporter of service is allowed, exporter of service, no, not allowed. So only exporter of goods is allowed, that too only a manufacturer is allowed. Trader allowed if he is tied up with the manufacturer. So if we talk about the industry, whether service sector is allowed here, whether exporter of services is allowed here, no. Whether trader per se is allowed here, no. Whether manufacturer is allowed here, yes. Whether trader having tie-up with the manufacturer is allowed, yes. So if I were to write this in a very simple manner, we will be discussing this entire concept of advance authorization or duty-free import authorization, EPCG in form of charts. Things will be very, very simple. So if you are talking about who are eligible, right? So if you are talking about who are all eligible, you have to understand that first you are talking about eligible persons for your advance authorization. Whether manufacturer exporters are eligible, manufacturer of goods exporters eligible, yes. Whether a trader of goods, merchant exporter, we call them as merchant exporter. Technically the first category is referred to as manufacturer exporter, second category is referred to as merchant exporter. And whether you are talking about provider of service exporter. So you are calling it as service exporter. Now you have to understand that manufacturer exporter is eligible to go for advance authorization. Whereas service exporter is not eligible to go for advance authorization. When you talk about merchant exporter, you have to understand two different things. If you are talking about merchant exporter, general scenario not eligible. Merchant exporter, special scenario, general scenario not eligible. Merchant exporter, special scenario. What is the special scenario? If the merchant exporter is having a tie-up with supporting manufacturer, tie-up, only then he is eligible. So if you look at this scenario, basically they talk about manufacturing in India, right? So who are all your eligible categories for your advance authorization? Your manufacturer exporter eligible, your service exporter not at all eligible, merchant exporter generally not eligible. In special cases he is eligible if he is having tie-up with supporting manufacturer. Now what this tie-up with supporting manufacturer means, friends? Tie-up with supporting manufacturer means, supposing you are talking about Z Limited, whose merchant exporter. Strictly speaking, Z Limited cannot apply for advance authorization, but Z Limited is tied up with A Limited, whose supporting manufacturer. Now what will happen is Z Limited will do the export of final product, but manufacturing and import of raw material and manufacturing will be done by A Limited, which means that this A Limited is importing the import of inputs, and A Limited converts inputs into final product, because A Limited is a manufacturer and A Limited supplies final product to Z Limited, and Z Limited is not doing any manufacturing work, just like that it is exporting. Now friends, what is happening is advance authorization is taken by Z Limited and import duty payment, which means export advance authorization is taken by Z Limited, means export obligation is promised by Z Limited, but import of raw materials, that is inputs, is not done by Z Limited, it is done by A Limited, and import duty will not be paid. So import duty will not be paid for the import of inputs done by A Limited. Import duty will not be paid for the import of inputs done by A Limited, right? Because of what? Because of your advance authorization taken by Z Limited. Now friends, if you look at things carefully, advance authorization is taken by a merchant exporter who is not manufacturing, right? He promises export obligation. He is promising export obligation, right? He is doing actual exports. He is promising export obligation, but what is happening is he is not importing the inputs. He is not manufacturing. Import of inputs and manufacturing of final product is done by A Limited, supporting manufacturer, who is importing the inputs using the advance authorization of Z Limited, not paying import duty, and converting the inputs into final product, right? If you look at this scenario, the triggering point is Z Limited. Z Limited tells that, right, I will take advance authorization. I have a lot of export orders. I will take advance authorization. If I am Z Limited, I will take advance authorization because I have a lot of export orders. I will apply for advance authorization as a merchant exporter. Now department DGFT will ask me that you are a merchant exporter, you cannot go for advance authorization. I tell, wait, I have a lot of export orders, but wait, I am not going to import the inputs. What I will do is, I have a supporting manufacturer tied up with me. Both are tied up. Both have a understanding. Now that supporting manufacturer will import the inputs, and using my advance authorization is not going to pay the import duty, right? He will convert inputs into final product and give it to me. I'll export. So the obligation is taken, export obligation is taken by advance authorization, and export obligation is taken by Z Limited, but he is not importing the inputs and manufacturing the final product. That is done by the supporting manufacturer, who will import the inputs, not pay any import duty. A Limited is importing the inputs, not paying any import duty. A Limited is not paying import duty, but based on advance authorization of Z Limited, who's promising export obligation. Z Limited is promising export obligation, but import of inputs is done by A Limited, supporting manufacturer. He is not paying any import duty. A Limited not paying any import duty on import of inputs based on advance authorization, that is promising of export obligation taken by Z Limited, merchant exporter. Then A Limited will take that inputs, convert into final product, give it to, because they are tied up, this final product will be given only and only to Z Limited, who will further export. So this is a tie up. If you look at this entire scenario, they are telling that manufacture should happen in India. So a merchant exporter who is tied up with a supporting manufacturer, right? So if you look at things carefully, it is a merchant exporter who is executing, who is taking advance authorization and promising export obligation, and he who is going to actually export the final product. But the import of inputs without payment of import duty is done by A Limited based on advance authorization of Z Limited, and conversion of inputs to final product is done by A Limited, and A Limited has to give that final product only to Z Limited. So that is the concept. Now friends, one small point we have left out when we have spoken about your eligible inputs. We have discussed that raw materials which are finding place finally reflected in your final product. Exception, wastage is allowed in terms of wastage norms given by your norms committee. Your fuel oil catalysts which are consumed or utilized in manufacturing process, or mandatory spares up to 10%. And a special scenario, specified spice which are used in crushing, grinding, sterilization, manufacture of oil and oleoresins, but not for your small works. When you are talking about your cleaning work or repacking work, not that. Now certain items are not eligible. If at all you are talking certain inputs, you cannot import using advance authorization. That are restricted items under your ITCHs, right? Canalized items under your ITCHs, and energy. These inputs, friends, you cannot import. Only the first category normal points you can import, but these inputs cannot be imported under advance authorization. When you talk about your restricted inputs under your ITCHs, Indian Trade Classification Harmonized System, restricted inputs, you cannot import under, you can import with permission, but not under advance authorization. In simple language, please pay import duty. You cannot use advance authorization. Canalized items which can be imported only by state trading enterprises, you cannot import under advance authorization. That can be imported only by state trading enterprises. And energy cannot be imported under advance authorization, right? So what are they trying to tell? If it is restricted inputs, you can import it with authorization or permission, but pay import duty. Don't use advance authorization. Canalized items, you cannot import it, therefore import can be done only by state trading enterprises. So the question of paying import duty or not paying import duty doesn't come when you talk about canalized items. And energy, you cannot import using advance authorization, which means that when you're importing energy, you have to pay your import duty. You cannot use your advance authorization. So these points are the base points. If you look at the base points, you will find that the first point, the basic meaning of advance authorization, we have discussed. What are the eligible inputs, we have discussed. Who are the eligible exporters, we have discussed. Right, steps for advance authorization we'll discuss in the end. We will discuss in the end when we compare advance authorization and duty free import authorization. Now what is the basis of issuing advance authorization? We have discussed that who can go for advance authorization. What is the basis of issue of advance authorization? Now friends, you know that only for advance authorization can be used only for eligible inputs, which we have discussed, and it can be the benefit of advance authorization for eligible inputs can be taken only and only by manufacturer exporter or merchant exporter tied up to supporting manufacturer. Not just like that. Merchant exporter who is tied up, which means that supporting manufacturer will import the inputs without paying import duty based on advance authorization of merchant exporter, and he will manufacture the final product, give it only to merchant exporter. That we have discussed with the flow chart, how it actually works. Friends, flow chart makes things very simple. Rather than discussing theoretically, you will know the picture how it is actually happening, right? Now friends, we are discussing that what are the possible ways where they can go for your advance authorization, possible means of getting your advance authorization. So these 3 points we have discussed. The basic concept of your advance authorization, which can be used only for eligible inputs, and who are the eligible exporters, right? A service exporter is not covered, a normal merchant exporter is not covered, only a merchant exporter who is tied up with a supporting manufacturer and a manufacturer exporter are covered. Now you are talking about in what ways you can go for advance authorization. If you want to look at this point, the heading tells that, forget about the steps we'll discuss when you're talking about your differentiation between advance authorization and duty free import authorization. There's a differentiation chart including the steps. What is the basis of issue of your advance authorization? On what basis DGFT will be issuing advance authorization? On what basis DGFT will be giving your advance authorization? Right, on what basis? There are certain bases. There are totally 4 factors that are talking about certain basis of issuing advance authorization. On what basis advance authorization will be issued? Basis of issuing advance authorization by your DGFT. Now friends, if you want to understand this, categorize this into 4 parts. First, you are promising to go by your standard input output norms, which means that you are talking about quantity. Standard input output norms. What is the standard input output norms? Because when you are fulfilling export obligation, one of the export obligation is fulfilling even the quantity. So you are telling that if I am importing 20 lakh units of inputs, and if the standard input output norm is 2:1, you have to export minimum 10 lakh units of final product. So export obligation both in terms of quantity and value should be satisfied. So the first basis of your advance authorization is you are going by standard input output norms given standard input output norms, or you can go for specified norms, special norms only for you before advance authorization, special norms, right? Specified input output norms which will be done only and only for you. You can ask for special norms. You are not satisfied with your standard input output norms. You are telling that no, I am not satisfied with this ratio of 2:1 because I know that it will be 3:1. Only if I import 30 lakh units of inputs, I can export 10 lakh units of final product. So you are telling that no, I am not satisfied with this standard input output norms. You go and apply to norms committee and you tell that please, I am giving all the factors, all the details of my manufacturing process. you please set a special input output norm for me. You please set up a special input output norm only for me. The standard input output norm will be common for all in that particular industry. This will be only for a particular company. So your standard input output norm is for a particular industry. And if you are not satisfied, you can apply for a special input output norm only for your company. Only for your company. Now friends, there is another scenario where there are two possibilities. Either you are talking about standard input output norms, or even otherwise at times you have ad hoc norms. Right? Either there is no standard input output norms or ad hoc norms. There is no standard input output norms or ad hoc norms, or your standard input output norms or ad hoc norms is there, but this particular manufacturer exporter is planning to purchase additional inputs, so which is not specified in that standard input output norms or ad hoc norms. Friends, the first category I can call it as standard input output norms. Second category is ad hoc norms. So when you're talking about third category, either you don't have either standard input output norms or ad hoc norms, or you have standard input norms or ad hoc norms, but you are planning to have import additional inputs, right? See, standard input output norms will talk about, supposing it is a final product is shirt. So standard input output norm will focus only on the fabric. So standard input is fabric and output is shirt. It will not talk about other items, right? So you are planning to import additional inputs which is not mentioned in your standard input output norms or ad hoc norms, right? In that case, friends, there are two scenarios. First scenario, either you don't have your standard input output norms, or you don't have ad hoc norms. You don't have it. Or if it is there, but you are planning to import additional inputs not covered by your standard input output norms or ad hoc norms. In such a scenario, you can go for self declaration. For those additional liability, you can go for self declaration. There are again two possible scenarios here. You can either go for self declaration or self ratification. You can either go for self declaration or self ratification. You will tell that what is the difference. The difference is, self declaration is for non-star houses, export star houses, 1-star export house, 2-star export house, non-star categories, non-star export houses. And friends, when you are talking about self ratification, self declaration concept is for non-star export houses, and self ratification is for star export house category. Star export house category, 1-star category, 2-star, all the stars, 1-star, 2-star, 3-star, 4-star, 5-star, $3 million, $25 million, $100 million, $500 million, $2,000 million that we have discussed. Now friends, what is happening here is, in self declaration, you have to give an undertaking to norms committee, and you have to abide by the wastage norms for that additional inputs given by the norms committee. Here in self ratification, because you are a star export house category, there is no need of any undertaking to norms committee. They are very big stars. The advantages, we have discussed this in your benefits of star houses. There is no need of any self declaration concept. When you talk about your advance authorization, if you remember, there was a self ratification. They will ratify, they will decide themselves. For the additional inputs for which there is no SION or ad hoc norms, they will decide themselves. Now friends, if you look at this scenario, we have already discussed that your advance authorization is only for eligible inputs. We have discussed 3+1 eligible inputs and 3 ineligible inputs, and it is only for manufacturer exporter or a merchant exporter tied up with supporting manufacturer. And what is the basis of issuance of advance authorization? Now we are discussing. The first basis is, go with the standard input output norms which is applicable for the entire industry, go with that. And if you are not happy with your standard input output norms, you can apply for a special input output norms only for your company. You can tell that no, the standard input or output norms, it's 2:1, which I feel is not right for, I'll submit all the data of my manufacturing activity, please change my input output norms. Because understand that export obligation, when you are seeing this, you have to understand that you have to fulfill export obligation both in terms of quantity and value. And when you are fulfilling the export obligation in terms of quantity, your standard input output norms or your ad hoc norms, even including self declaration or self ratification, will work out. You have to reach that quantity. If the standard input output norms is 2:1, and if I am importing 20 lakh units of inputs, necessarily 10 lakh units of output should be exported. I may not be happy with that. I will tell her no, it's 3:1. Right. So if it is 3:1, I'll tell that I cannot export 10 lakh units and all. Right. For 20 lakh units of inputs imported, I can export only 20 lakhs multiplied by 1 divided by 3. Right. So I can export my input output ratio is very, very different now. So I cannot export 10 lakh, I cannot export 10 lakh units. That is not possible from my end. So approximately 6 lakhs 60,000 odd amount only I can export. So that will be happening there. To be very specific, 6 lakh 66,667 is the export of your final product in that scenario. Now there are certain cases, friends, where there is no standard input output norms for a particular product, input and output, or there are no ad hoc norms, or if there is a standard input norm or ad hoc norm, but you are importing additional inputs, not going by the standard input output norms inputs or ad hoc norm inputs, you are importing additional inputs, extra inputs which are not covered by this norms. In such a scenario, if you are a star house, then go for self ratification. Giving an undertaking to norms committee is not at all required. If you are a non-star house category, if you don't have 1 star, 2 star, 3 star, 4 star, etc., you are not a status holder, then it is self declaration, but you have to give an undertaking to the norms committee. Wastage should be in prescribed terms with the norms committee. So this, friends, you have to understand. So this issue you have to clearly understand. Right. Now, friends, we are talking about the main discussion. If you look at this now, steps for the advance authorization. Okay, let me complete the steps for advance authorization in a very simple manner. Very simple manner. If I am talking about the steps, you're talking about the steps for your advance authorization, a very simple manner, right? So that when we compare it with your duty free import authorization, it will be more simple, right? What are the steps? First step, friends, you have to apply for advance authorization. So this exporter will apply for advance authorization, application for advance authorization to DGFT. Then you will get advance authorization. You are going to get advance authorization. Then, friends, you have to execute a bond or bank guarantee. You have to execute a bond or bank guarantee with your customs. Initial 3 steps. So initial 3 steps are nothing but your basic processing. Please apply for advance authorization with DGFT. Authorization is permission. Then you get the advance authorization. After you get the advance authorization, execute bond or bank guarantee with your customs department. Then, friends, you have to import your inputs. Import your inputs within 12 months. Within 12 months of issuance of advance authorization. 12 months of issuance of advance authorization, and you have to fulfill your export obligation, because now you are importing your inputs without payment of import duty. You have to fulfill your export obligation within 18 months not from the date of imports, from the date of issuance of advance authorization. From the date of issuance of advance authorization. This is the second and the main step. The main step. Now you import your inputs without paying import duty, but that import should happen within 12 months of issuance of advance authorization, and within 18 months, again starting from the date of issuance of advance authorization, not from the date of import, starting from the date of issuance of advance authorization, fulfill your export obligation both in terms of your quantity and value, and submit it to the DGFT. Now after you fulfill your export obligation, you have to submit to your DGFT telling that I have fulfilled my export obligation, and DGFT will give. Now what will happen? The last step, you are talking about the last step. Your DGFT will give you export obligation discharge certificate. Will give you export obligation discharge certificate because you have fulfilled your export obligation, right? And your customs will cancel your bond. This copy of export obligation discharge certificate will also be given to customs, and your customs will cancel your bond or your bank guarantee. So this is the broad steps. Obviously in between also time limits are there, which is not given by ICA material. I have given extra time limits, forget about it. The main time limits I have written. Within 7 days you will get advance authorization. After you fulfill your export obligation, within 2 months you have to submit to DGFT telling that my export obligation is over, and thereafter DGFT will give your what to say, export obligation discharge certificate. That is all, forget about all these points. So if you like to talk about the last step, intimate completion of export obligation both to DGFT and customs. So that will be done by the exporter. So exporter will intimate that I have completed my export obligation both to DGFT and customs. DGFT will give export obligation discharge certificate both to the exporter and the customs, and customs will cancel your bond or bank guarantee. These are the steps. Right. First, exporter will apply for advance authorization from DGFT. He'll get advance authorization. Exporter will give bond or bank guarantee customs. Thereafter, exporter has to import inputs within 12 months from the date of advance authorization, right? And he has to fulfill his export obligation. He has to make exports within 18 months from the date of issuance of advance authorization. Finally, the exporter will intimate that I have completed my export obligation both to DGFT and customs. DGFT will give export obligation discharge certificate to the exporter along with a copy to the customs, and customs will cancel the bond or bank guarantee. These are the steps for your advance authorization. What is very important is this point. You have to import the inputs within 12 months. Within 12 months from the date of issuance of advance authorization, where you are not going to pay any import duty. And you have to fulfill your export obligation. No duty drawback. Fulfill your export obligation within 18 months from the date of issuance of advance authorization. So these are the steps which you have completed. So at the time of differentiation, it will be very easy to compare your advance authorization and duty-free import authorization. Friends, our discussion is only and only about advance authorization as of now. Finally, once we are done with advance authorization, a simple comparison will help you out. Now friends, if you look at the basis of issues of advance authorization is also done. Now the most important thing that comes up is fulfilling the export obligation. So this happens to be the most important thing. If you don't fulfill the export obligation, duty will be recovered along with interest and penalty, plus other proceedings will also start. Now you have to fulfill your export obligation within a particular point of time. And this export obligation you have to clearly remember, because in exams they are focusing only on your export obligations. How you have to fulfill, we have 4 or 5 examples to even understand that. So that will be very simple to understand. You have to fulfill your export obligations. Now how to understand this export obligation? Yes, now you have to fulfill your export obligation. If you have imported inputs free of duty, now you are required importer of inputs free of duty should be within 12 months from the date of issuance of advance authorization, and you have to fulfill your export obligation within 18 months from the date of issuance of advance authorization. Now you have to fulfill your export obligation both in terms of quantity as well as in terms of value. Both in terms of your quantity as well as in terms of your value. Now friends, when you are talking about fulfilling your export obligation in terms of quantity, it is quite simple. If at all in terms of quantity, you have to follow your standard input output norms. If not, you have to go with ad hoc norms specifically given to you by norms committee. By norms committee. Your standard input output norms will already issued by your DGFT. Right, either go with your standard input output norms given already by DGFT, or go with ad hoc norms which is given to you by norms committee. By norms committee, that we discussed 4 types of committees are there. One type of committee is norms committee, either or. Right, so that is with respect to quantity. And simultaneously, friends, you have to fulfill your export obligation in terms of value. So you have to fulfill both. So your export obligation, friends, your export obligation should be fulfilled both in terms of your quantity and in terms of your value. What we have discussed till now is only your quantity. Now in terms of value, friends, your value addition should be minimum 15%. Normally, general. And for T, your value addition is 50%. Only and only for T. This comes repeatedly in your 1 mark or 2 mark questions. So your normal value addition required for advance authorization. Our entire discussion, friends, is only and only about your advance authorization. We have not yet started with duty free import authorization. I am repeating this again and again. Finally, once we are done with this advance authorization, duty free import authorization will be very, very simple. Now here it is, friends, 15%. Normally value addition should be 15%. Exceptionally, in case of T, normal sector it is 15%. For T it is 50%. Now friends, what is this value addition? How to calculate this value addition? Value addition? Friends, this value addition is equal to your export value minus your import value divided by your import value multiplied by 100. So it is nothing but, I may write this in a better way so that you are not confusing with this formula. The denominator is import value multiplied by 100. This should be, normally it should be more than 15%. For normal sector it should be more than 15%, and if it is a T sector it should be more than 50%. Right, so this value addition should be more than 15% normally. Special cases 50% for T. 50% for T. Normally it should be more than 15%. More than 15%. Now friends, what all will be included for your export value? What all will be included for your export value? Your export value, friends, will include your FOB value for actual exports. Here deemed exports will also be allowed, that will also discuss. FAR value, so even deemed exports will be counted. FAR value for deemed exports, FOB value for actual exports, FAR value for deemed exports, right? And friends, your import value, when you are talking about your import value, these are the two main additions. When you are talking about your import value, you are talking about your CAF value of the corresponding inputs, right? So you are talking about your CAF value of inputs imported against advance authorization plus CAF value of inputs on which you have paid import duty but you are going to go for duty drawback. Both. So it is not only that inputs which you have imported under advance authorization, but also import of those inputs which you are going to claim duty drawback. So you cannot restrict yourself only in seeing those inputs. See, I may have two types of inputs which I discussed in the beginning. One input I am going for advance authorization without payment of import duty. Another input I am going for duty drawback. So I have to club both. CAF value of all imported inputs. Simple language. CAF value of all imported inputs. Either whether I have gone for advance authorization, I have not paid import duty, or or I have paid import duty, I am going to go for duty drawback. I am going to go for duty drawback. So this is a very important point, right? So this will be the normal calculation, friends. Plus there's one more thing that you have to understand. If you are talking about free samples that are imported, CAF value of inputs which are not export of free samples, that we have discussed in the export policy, that we have already discussed in your star house category, right? So the benefit of exporting samples for export promotion, what is the limit, that we have discussed. That we are talking about import of free samples. Import of free samples, we are going to add that also. CA value of your inputs where you are talking about free samples, where you are talking about your free samples, even that has to be added here. So if you look at your calculation, friends, if you look at your calculation, right, how you have to find your, what is the export obligation required in terms of your quantity? Either you have to go with standard input output norms given by your DGFT, right, in your ITCHS, that is Indian Trade Classification Harmonized System, or you can apply for ad hoc norms specially for your company with the norms committee. In terms of value, normally validation required is 15% generally, and if it is T sector, they require 50%. And how to calculate valuation, friends? Valuation is equal to your export value minus the import value. Export value, friends, is always on FOB basis, right? So import is always on CAF basis. Don't forget that basic thing from your customs. Divided by your import value multiplied by 100. That should be more than 15% normally. If it is 40, it is more than 50%. Now, when you talk about your export value, you are going to include both your actual exports and deemed exports. You are going to include your actual exports as well as deemed exports. So your export value is FOB value for your actual exports and FAR value, rather not FAR, FOR, free on road, FOR value for your deemed exports. Say for example, giving it to 100% UU, even that will be counted here for export value. Whereas your import value, friends, is CAF value of inputs. Here FOB value and FAR value is of final product. It is of final product, and obviously import values of inputs. CAF value of inputs imported against advance authorization. CAF value. The second point is very important. Even the inputs that you have imported, paid import duty, and you are going to take duty drawback, even that will be counted. So second and the third point here is very important. Likewise, here second point is very important. And friends, what is the third point for your import value? CA value of inputs which are imported as free samples, but there will be customs valuation. Either you may have gone for your advance authorization for that free samples, or you may have gone for duty drawback. So that really doesn't make any difference, but it is free samples that has to be included. Alright, so this point, friends, is given in your export obligation. And if at all, of course, if you are not fulfilling export obligation, friends, what will happen? If you are not fulfilling export obligation, recovery will happen of duty, interest, penalty, plus other proceedings under foreign trade policy will start. So this export valuation, export obligation of your quantity, we have thoroughly discussed. Of your value, we have thoroughly discussed, and we have seen how to calculate it. Now let us see the examples and complete your export obligation concept, because lot of questions are asked only from this export obligation. Now let us see this particular point. Dhanush Limited has imported inputs without payment of duty under advance authorization. CAF value of such inputs is 50 lakhs. The inputs are processed and final product is exported. Exports made by Dhanush Limited are subject to general rate of validation, which means 15% for your advance authorization. No other input is used by Dhanush Limited in the processing. What should be the minimum FOB value of the exports made by Dhanush Limited to satisfy the provision of advance authorization? Friends, it is quite simple. What is your import value? Your import value, and there is only one input which is under advance authorization. It is your import value of input, your import value of input, and which is only and only against advance authorization, that is your 50 lakhs. And friends, what is the minimum validation that is required? You require 15%. So minimum FOB value of your final product should be 50 lakhs. Directly I can add 15%. 15%, which is equal to 57 lakh 50,000. 57 lakh 50,000. A very normal question, basic question. They are telling that please calculate what should be the minimum export value. What should be the minimum export value? Now let us see the next question. At times you have to do some mathematical plus and minus to get the answer. That's it. That's nothing special. You have to just understand the concept. You have done with the concept. At times you have to do some mathematical plus and minus. Now compute the validation. Now they are not talking about export value. They are talking about validation, whether you have achieved the validation or not. In the previous question they have asked what is the minimum FOB value that is required. Now they are asking what compute the validation. Value of inputs under advance authorization, duty free import 50 lakhs. Value of inputs, duty drawback facility, which means that you have paid the duty but you are going to claim duty drawback. Even that will be added in your import value, 25 lakhs. FOB value of export is 90 lakhs. That's it. Now if you are to calculate validation here, what is your export value, friends? Export value is 90 lakhs minus what is your import value? Import value is 50 lakhs input 1, which you have gone for your advance authorization, and 25 lakhs input 2, which you are going to claim duty drawback, divided by import value, which is 50 lakhs plus 25 lakhs multiplied by 100. So you are going to get 90 minus 75 will give you your 15 lakhs divided by 75 lakhs multiplied by 100. That is nothing but 20%. 20%. This will give you mathematically, if you use your calculator, it will give you 20%, and you have to tell that you have reached your export obligation. You have achieved your export obligation. And friends, this export obligation should be achieved within how much time? 18 months from the date of issuance of advance authorization. And import should have been done within 12 months from the date of issuance of advance authorization. So this is equal to 20% if you use your calculator, and you have achieved your export obligation. Friends, next question. Very simple. You have to just understand this. Use the formula. That's it. AB Limited, an exporter, is engaged in export of ready-made garments. AB Limited has got an export order of FOB value worth 500 lakhs. They are asking in a reverse way. Now they are telling you reverse way that you have an export order of 500 lakhs. What is the maximum CIF value of imports to fulfill the minimum validation condition? Which means that they are telling that this validation which is required is 15%. So you have to achieve at 15%. You do know the export value, which is you have order of 500 lakhs. You do not know the import value. So you have kept it as X divided by X multiplied by 100. This you have to put in calculation. See, now they are keeping, in the first question they said calculate validation. Rather, in the first question they said calculate the value of FOB value of export. In the second question they said calculate validation. In the third question they are telling in a reverse way. You have your export order value. So you know FOB value of export, and you know what is the minimum validation should be achieved to be achieved in advance authorization. That will not be given in the question. You should know that the minimum validation required in advance authorization is 15%. So you know that you have to reach 15%, minimum 15% you have to reach. You know your export value, you are required to calculate your import value. So what is the validation formula, friends? Your export value minus import value divided by import value multiplied by 100, which is equal to 15%. So you have to calculate X. Use your calculator and you have to calculate X. Now friends, if you do this mathematical formula, if you find out this X, you will get final answer as 434.78 lakhs. 434.78 lakhs. So if you are calculating your X, you will get this particular answer. You are going to get this particular answer, right? So this way you have to find out different things. Now friends, the next question. FOB value of exports of MSD Limited is 500 lakhs. So you know the export value now. Foreign buyer has supplied goods free of cost. This is free of cost, which means samples, free samples, for use in manufacture of goods exported. And the value of such goods, customs valuation will be there even for the free samples, 100 lakhs. What is the maximum CIF value of actual imports? Apart from this notional import, what is the maximum CIF value of this actual imports to fulfill the minimum validation condition? Friends, again a very simple question. You know the minimum validation that is required under advance authorization is 15%. So you have to achieve that 15%. You are required to achieve that 15%, right? Do you know the export value? Yes. You know the export value that you are having is 500 lakhs. Minus, friends, now the import value is not X, it is 100 lakhs, because you are talking about free samples imported. 100 lakhs plus X, 100 lakhs plus X divided by 100 lakhs plus X import value multiplied by 100. See, once you have seen the concept, it is very simple. Now you have to do your cross multiplication and find out X. Now you have to use your mathematics and find out X. Now what is said is they have given the export value. So you know 500 lakhs FOB value. They have said that you have to achieve the minimum validation, which is 15%. That you have to remember for advance authorization is 15%. Now import value, if you remember, I said 3 important points you should remember. It is CAF value of imports under advance authorization, CAF value of imports for which you are not going under advance authorization but you will be claiming duty drawback, even that has to be included, plus CAF value of free samples imported, free of cost samples imported in India, even that has to be free of cost imports in India. That need not be samples actually, free of cost inputs imported in India. So calling it as samples is incorrect. Free of cost inputs imported in India, even that has to be included. Now if you look at this, your import value is not only X, it is 100 plus X. It is 100 plus X. So you have to do this calculation and get the answer. Right, when you do this calculation, first you will get the answer of this particular thing. You try to get the answer, you keep this as X and try to find out the answer. And when you keep this as X, minus 100 lakhs. So what it is done is, first step, you can directly find the same 434.78 lakhs. So you can keep this entirely as Y. Rather than keeping it as X, you can keep this as Y entirely. Find out Y. Right, and X will be equal to Y minus 100. Y minus 100 lakhs. So you can keep this entire thing as Y, which means the entire import value. You can keep this entire thing as Y, the entire import value. Simple steps. You can have multiple ways to work out your mathematical question. You can keep this entire value as Y, find out Y, then X will be equal to, the actual imports will be equal to the total imports minus import of free of cost materials. So first you find 438.78 lakhs by finding Y, then 434.78 lakhs minus 100 lakhs. Actual imports, not free of cost, actual imports is 334.78 lakhs. So that you can work it out. Right friends, all you have to remember is the formula. Validation requires minimum validation under advance authorization is 15%. For T it is 50%. How to calculate validation? Export value, which includes FOB value of actual exports, FOR value of deemed exports, free on road value for deemed exports, even deemed exports that could have been asked in your question. Then the next thing, what is your import value? Export value minus import value divided by import value multiplied by 100. Export minus import value divided by import value multiplied by 100. What is your import value? Import value consists of 3 important things. CAF value of import, actual imports done under advance authorization, no payment of import duty. CAF value of import, that is another inputs for which you have paid import duty but you are going to go for duty drawback, even that has to be added. And CAF value of free of cost imports. You may not call it as samples, free of cost imports which are using it in manufacture. Free of cost imports, rather than calling it as samples, call it as free of cost imports which will be used in the manufacturing process. Even that has to be added. So you have to remove the formula, and something missing, they will be giving this question in a different way. You have to find out the missing figure. They may tell first find out the validation, they may tell find out the export value, they may find out the import value. right? You have to find, I mean, these three questions was all about finding out your export value, or finding out the percentage, or finding out the import value. And the last question was 2 steps. First, find out the entire import value CIF minus free of cost imports that is given, which will be the actual import value, which is on paid basis. You are paid for that, it is not free of cost imports. So that you have to understand. That is all about your export obligation, a very, very important thing that is repeatedly asked in your exams. And friends, when you talk about the last category, you are talking about your categories of your advance authorization, what to be included, what not to be included, plus the benefits. So what is completed till here is, till all the points till here is completed. What we have to see is how to calculate your what all categories of advance, I mean, for what all exports you have the benefit of advance authorization, and what is the actual benefit. I have said you are not required to pay import duty, not required to pay import duty, not required to pay import duty. What is that import duty that is not required to be paid, that we'll discuss. So we are going to merge the categories of advance authorization and the duties exempted, including this domestic procurement of goods. So we are going to club all these three things. Advance authorization on annual basis we'll discuss in the end. Now let us understand with the help of a flow chart again. Now you are talking about a scenario where you are importing the inputs. And exporting the final product. Right. Now friends, let us understand this. Either you are talking about as actual manufacturer exporter who's importing the inputs, import of inputs, right, and who's either exporting the final product or giving the final product to special economic zone. So here you are talking about export of final product or supply of final product to special economic zone. Both are covered. Special economic zone. And what you are doing in India is manufacturing. What is happening in India is manufacturing. Either you are talking about this manufacturing work done. Either you are talking about a manufacturer exporter directly who is doing all these things, or you are talking about merchant exporter who is tied up with supporting manufacturer, which we have discussed earlier. Right, manufacturer exporter is getting advance authorization, but the import of inputs and manufacturing is done by the supporting manufacturer who will give him the final product and he'll export. Right. Now you are talking about what scenario? Here friends, your import duty is not paid. Here friends, at your import duty is not paid, and when you are fulfilling your export obligation, this export obligation will be counted. Whether it is export of final product to outside India or supply of final product to special economic zone. Right, it will be counted in your export obligation. Obviously friends, you are not talking about duty drawback. Both will be counted in your export obligation. Your export from India to outside India will be counted, plus your supply to special economic zone will also be counted. Friends, you are talking about your FOB value. Which will be counted for your export obligation. Normal scenario. I am starting with a very, very normal scenario. What is this normal scenario, friends? You are talking about import of inputs, normal scenario of advance authorization. This advance authorization, friends, is either applied by manufacturer exporter or merchant exporter who is tied up with a supporting manufacturer. Merchant exporter is getting advance authorization, but the import of inputs and manufacturing of final product is done by supporting manufacturer, who will give him the final product, and merchant exporter will export them, right? So there is an import of inputs without payment of import duty against this advance authorization, which is either applied by your manufacturer exporter or merchant exporter who is tied up with supporting manufacturer. Now friends, thereafter manufacturing is happening, and either the final product is exported or it is supplied to special economic zone. In both the cases friends, it will be counted for your export obligation. So actual export, even supply to special economic zone, is always at par with the actual export. The only thing that you have to understand is your supply to special economic zone and deemed exports is not counted for your MEIS and SEIS. For other benefits of foreign trade policy, they are always counted. So you are talking about FOB value, both for your actual export and supply to special economic zone. A very normal scenario, a very normal scenario, right? So here one special thing that we have discussed is even the supply to special economic zone will be counted. Now friends, we are talking about a very special case, a very special case. So you have to pay due attention because this requires a very special understanding. Now import of inputs. Import of inputs is by A Limited. It is by A Limited, which is actually giving it to Z Limited, and friends, Z Limited is exporting the final product. Z Limited is exporting the export of final product, right? But you are talking about intermediary supplies against advance authorization. Now friends, Z Limited has applied for advance authorization, so I am calling it as advance authorization 1. Even A Limited has applied for advance authorization. I am calling it as advance authorization 2, right? Either Z Limited is an advance authorization holder or Z Limited is EOU. Z Limited is EOU, right? Either Z Limited happens to be an advance authorization holder or Z Limited is 100% export oriented units. Now friends, what is happening? What is happening is this particular A Limited, let us assume that he is giving the imports just like that, inputs just like that. He is not manufacturing it. He is not manufacturing it. So he is not a manufacturer. So be very clear, you are not talking about a manufacturer. He is a merchant trader rather. Actual manufacturing is done by Z Limited. Actual manufacturing is done by manufacturer exporter. So we are not talking about supporting manufacturer. Please don't get confused. Supporting manufacturer, what has happened is merchant exporter will export it, but the manufacture will be done by the tied up supporting manufacturer. That is not the case. No, there is no tie up. There is no tie up. Now friends, ulta scenario. So you are talking about Z Limited. You are talking about Z Limited, who is actually manufacturing it, which means that what is supplied by A Limited to Z Limited is inputs, and Z Limited converts the inputs to final product. Z Limited converts the inputs to final product and exports the final product. A Limited imported the inputs and gave the inputs to Z Limited, right? Now friends, even Z Limited can apply for advance authorization. Friends, now there are two advance authorization which are working. Friends, please differentiate this with merchant exporter tied up with supporting manufacturer, because there is only one advance authorization which is working. Now Z Limited is having advance authorization because it is actually exporting, it is actually manufacturing and exporting the final product, manufacturing the final product and exporting the final product. And friends, A Limited is having advance authorization because, not because it is manufacturing, it is giving the goods to an advance authorization holder or an 100% EOU, deemed exports. Rather, both will be called as deemed exports. When you see the last subtopic of your FTP, both are called as deemed exports. Supplying it to export oriented unit or supplying it to an advance authorization holder, both are called as deemed exports. Both are called as deemed exports. Now, if I were to write this here very clearly, the first is a transaction of deemed exports. So, A Limited to Z Limited is deemed exports and Z Limited outside India is actual exports. And both are having separate advance authorization. So, Z Limited is having its own advance authorization and A Limited is having its own advance authorization. Z Limited is having its own advance authorization because directly Z Limited might import something. It may not necessarily get from only A Limited. Directly Z Limited may get something from outside India, right? For A Limited can also enjoy the benefit of advance authorization, is not going to pay import duty, and this deemed export, friends, will be his export obligation. This deemed exports will be his export obligation. Right. Obviously, for Z Limited, export obligation is actual exports. Export obligation of Z Limited is actual exports, export obligation. The difference is, when you talk about your actual exports, you take into account FOB value. When you talk about deemed exports, if you remember, in export obligation, you also consider FOR value, because even deemed exports is included. Deemed exports is included. So, if you connect these points, he is getting the benefit of, A Limited now is getting the benefit of not paying import duty, and his deemed exports, he is not actually exporting outside India, he is supplying to Z Limited. Z Limited is EOU or another advance authorization holder, that will be counted as his deemed exports. Even he can enjoy this advance authorization of not paying import duty. So, that deemed exports will be taken as export obligation. You are focusing on FOR value. Friends, the focus is only on this part. A Limited is neither manufacturer exporter nor merchant exporter tied up with supporting manufacturer. A Limited is importing the inputs, selling the inputs just like that to another manufacturer exporter who is either an advance authorization holder or an export oriented units. A Limited is giving to Z Limited, which is either an 100% export oriented unit or an advance authorization holder. Right. So, what A Limited is doing is deemed exports. Friends, for this deemed exports also, A Limited can apply for advance authorization. The point is, both are working in different advance authorization. So, now A Limited has applied for advance authorization not for the actual exports but for the deemed exports. So, now when A Limited applies for his own advance authorization, he will import the inputs without paying import duty. And when he is giving these same items, he is not doing any manufacturing work. The same material, when he is giving it to Z Limited, which is an 100% EOU or an advance authorization holder, this will be called as deemed exports, and that will be counted for his export obligation. And that will be FOR value. Now, friends, if you look at both these cases, let us assume that in this scenario, this manufacturer or merchant exporter tied up with supporting manufacturer was A Limited. Now, look at this difference. Look at the differences. You are talking about either directly you are talking about A Limited manufacturer exporter, or you are talking about supporting manufacturer being A Limited, but who is tied up with merchant exporter Z Limited. But in the first example that we have discussed, you are talking about only one advance authorization. You are talking only about one advance authorization. Either it is only A Limited, so only single advance authorization. Even if it is A Limited, Z Limited, both of them are working with single advance authorization. Why? Advance authorization is taken by merchant exporter who is tied up with supporting manufacturer, who will import the inputs without import duty and manufacture it and give it. So both are working. There's only one advance authorization. There's only one advance authorization here. Even though you're talking about merchant exporter tied up with the supporting manufacturer, both should be closely connected. There's only one advance authorization here. Only one advance authorization here. Even if I'm focusing on A Limited and Z Limited, there's only one advance authorization. Why? A Limited takes advance authorization, merchant exporter takes advance authorization, that is rather Z Limited. Z Limited takes advance authorization, that is merchant exporter takes advance authorization, who's tied up with the supporting manufacturer. This supporting manufacturer A Limited will import the inputs without paying import duty using advance authorization of merchant exporter Z Limited. May convert this input into final product. So supporting manufacturer will convert or manufacture this inputs into final product and sell it only and only to this merchant exporter who is going to export. So there is only one advance authorization. Whereas in this example, friends, there are two advance authorization. You are talking about the first advance authorization and the second advance authorization, two advance authorization. So friends, here A Limited is having separate advance authorization and Z Limited is having separate advance authorization. And one more important difference, A Limited is not a supporting manufacturer. No, he is a trader. He is importing the inputs and selling it to Z Limited. So he is a merchant trader. He is not a supporting manufacturer. So he has to take separate advance authorization. So there are now two advance authorization. So you are talking about two advance authorizations. One with Z Limited, who is the manufacturer exporter, one with A Limited, who is a merchant trader. He will import the inputs and give it to the output. So that is the first difference. And second difference, when you talk about, and here second difference is, here finally there will be actual export. Here the focus was all on actual exports. The focus was all on your actual exports. It was either final export was actual exports. It was either exported outside India or supplied to special economic zone. And here, friends, the first focus here is on deemed exports. Obviously, for Z Limited is actual exports, but the first focus here is deemed exports. That is the second difference. And friends, the third difference that you have to understand, which is very important, when you talk about your import duty payment, here all the import for actual exports, all import duty are exempted. So your all customs duties are exempted. All customs duties are exempted, including your IGST and compensation cess are exempted till 31st of March 2021. So here, when you are not paying import duty, when I tell you are not paying import duty for your actual exports, I am telling that you are not paying any import duty, including your IGST and compensation cess. Your customs duty will include IGST and compensation cess. That is also exempted up to 31st of March 2021. But here for deemed exports, when I am telling that for deemed exports also import duty is exempted, what is exempted here, friends? You have to understand. What is exempted is your other normal customs duties. Your customs duties are exempted, which means your BCD is exempted, your social welfare surcharge is exempted, your safeguard duty is exempted, your anti-dumping duty is exempted, etc. Right, protective duty is exempted, all of them are exempted, but you have to pay IGST and compensation cess. That is not exempted. So when I tell for deemed exports you are not paying import duty, I am trying to tell that you are not going to pay basic customs duty, social welfare surcharge, safeguard duty, anti-dumping duty, etc. You are not going to pay all these duties, even special import duties, but you have to pay IGST and compensation cess. So that you have to understand. Now friends, if I were to differentiate this, when you talk about your actual exports versus your deemed exports, your actual exports versus your deemed exports. The differences, if you have to summarize all these points in form of your points, summarize, differentiation point, actual exports versus deemed exports. When I am talking about your actual exports, friends, I am talking about India, USA, and I am talking about India Special Economic Zone. Right, when I am talking about your deemed exports, I am talking about two people, right? So I am talking about India to an authorization holder. Right, there are a lot of other categories of deemed exports. So I am talking only about two now. India DTA, rather I can write it as DTA. So actual exports, friends, I am focusing on your domestic tariff area to your USA, or friends, I am focusing on your domestic tariff area to your special economic zone. Friends, here deemed exports I am focusing on domestic tariff area to advance authorization holder or domestic tariff area to 100% export oriented units. There are other cases of deemed exports, therefore I am writing it as etc, etc, etc. First difference. Second difference, which is very important. The benefit here is, friends, for whom? Manufacturer exporter or merchant exporter tied up with supporting manufacturer. Tied up with supporting manufacturer. For example, this example I can write it is as you are talking about A Limited and giving it to Z Limited, but they are working as one. They are working as one unit. Z Limited merchant exporter takes advance authorization, but the benefit of advance authorization is taken by supporting manufacturer A Limited, who imports the input without paying import duty and manufactures the final product and gives it to Z Limited. So they are working as one unit because the entire supplies of supporting manufacturer A Limited, so entire supplies of your supporting manufacturer A Limited will be given to Z Limited. So they are working as one unit, and therefore in both these cases, whether there is only one person merchant manufacturer exporter or merchant exporter tied up to manufacturer exporter, friends, you are talking about a single advance authorization. So they are working with one advance authorization. So advance authorization is taken by Z Limited merchant exporter, and import duty payment not paying the import duty benefit is taken by A Limited, who will also convert the inputs into final product and supply it to Z Limited. Now, friends, when you talk about your deemed exports, you are talking about a very different scenario, You are talking about what? A Limited supplying to Z Limited. A Limited will have imports. Now they are not working as one unit. A Limited is having one advance authorization. Z Limited is having another advance authorization, or Z Limited is UU. So they are working as independent units. They are not working as one unit. And A Limited basically, friends, now in this previous case, A Limited was supporting manufacturer. He was a manufacturer, and Z Limited was merchant exporter. Now A Limited, friends, is a merchant who is importing it, but is a merchant trader. He is not a manufacturer. And Z Limited is a manufacturer. Z Limited is actually manufacturer exporter. So if you look at the difference in your actual exports, even when you are talking about merchant exporter tied up to a supporting manufacturer, they actually work as one unit. Now in deemed exports, they work as a different unit. So A Limited is importing the inputs and giving it to Z Limited. He is not doing any manufacturing work. So he is a merchant trader, merchant importer and trader. Neither he is not an exporter, merchant, importer and trader. Right. Now, friends, if you look at the scenario, there are two advance authorization here. There may be two advance authorization, the first advance authorization and the second advance authorization. I am ignoring EOU concept, but basically there are two advance authorization. A Limited is having advance authorization for deemed exports and Z Limited is having advance authorization for actual exports. Right. Now other differences that are there is, when you talk about actual exports, friends, you focus only on, when you talk about your actual exports finally done by your manufacturer exporter or merchant exporter tied up to supporting manufacturer. So when you talk about your actual exports, friends, you focus on your FOB value. Here when you talk about your deemed exports, you focus on FAR value. And friends, the last difference, when I tell that you are going by advance authorization, the benefit of not paying import duty, you are not paying any kind of import duty. You are not paying BCD, social welfare surcharge, protective duty, anti-dumping duty, safeguard duty. No, you are also not paying IGST and compensation cess. But the benefit of not paying IGST and compensation cess is only up to 31st of March 2021. Right. But when I tell in deemed exports, A Limited, which is importing the input and selling as such to Z Limited, who is an advance authorization holder, EOU, and they are not working as one unit. So you are going by FAR value deemed exports. The benefit is not paying BCD, social welfare surcharge, protective duty, anti-dumping duty, safeguard duty, etc., even anti-subsidizing duty. So that is same, but you have to pay IGST and compensation cess, that you have to pay. So when I talk about benefit of actual export, you are not paying any customs duty, though you are not paying IGST and compensation cess only up to 31st of March 2021. So the benefit of not paying BCD, social welfare surcharge, protective duty, anti-dumping duty, safeguard duty, anti-subsidizing duty is permanent. But the benefit of not paying IGST and compensation cess is only for actual exports, and that too it is only up to 31st of March 2021. And when you talk about deemed exports, the deemed exporter, he is not required to pay import duty of BCD, social welfare surcharge, protective duty, anti-dumping duty, safeguard duty, anti-subsidizing duty, etc., permanently. And he is not getting the benefit of not paying IGST and compensation cess. He has to pay IGST and compensation cess. So first thing is, when you talk about actual export, you are not paying any import duty, including IGST and compensation cess. Yes, but for IGST and compensation cess, the exemption is only up to 31st of March 2021. For other customs duties, it is permanent. But for IGST and compensation cess, it is temporary exemption only up to 31st of March 2021. But when you are talking about deemed exports and the deemed exporter importing the inputs, he is not required to pay. The import duty being BCD, protective duty, BCD, social welfare surcharge, protective duty, anti-dumping duty, safeguard duty, anti-subsidizing duty, all these import duties he is not required to pay. But he is required to pay IGST and compensation cess. So the benefit of not paying customs duty is there even for deemed exporter, but for other customs duties, for IGST and compensation cess, there is no exemption. So if I were to put only this duty point in a very simple manner, if it is, I am just writing this same point, duty exemption point, if it is actual export and if it is deemed exporter, actual exporter and the deemed exporter, the actual exporter will not pay import duty, whether it is BCD, social welfare surcharge, protective duty, safeguard duty, anti-dumping duty, anti-subsidizing duty. Will also not pay IGST and compensation cess. But the difference is, he is not going to pay all these duties without any limit, without any restriction. But when you talk about benefit of not paying IGST and compensation cess, that benefit is only up to 31st of March 2021. That benefit is only up to 31st of March 2021. Earlier it was up to 2020, now it is extended up to 2021 because your FTP is also extended up to 31st of March 2021. For deemed exporter, when he is importing the inputs and he is not paying the import duty because he is giving it to another advance authorization holder or EOU. He is not paying import duty. What he is not paying import duty? He is not paying BCD, he is not paying social welfare surcharge, he is not paying protective duty, he is not paying safeguard duty, he is not paying anti-dumping duty, he is not paying anti-subsidizing duty. So all these things will be the same. But when you talk about IGST and compensation cess, is required to pay. Is required to pay. So difference lies here. For an actual exporter, the benefit of not paying import duty is for all import duties. Is for all import duties, and it is even for IGST and compensation cess portion of import duty, but only up to 31st of March 2021. For a deemed exporter, when we tell that he is not going to pay import duty, he is not going to pay import duty for sure. All the other import duties he is not going to pay, but he has to pay IGST and compensation cess. But he has to pay IGST and compensation cess. So that, friends, you have to remember, right? So now if you look at all these points, the benefit, what is included: physical exports, supply to special economic zone, intermediary supplies, deemed exports, all these points, this categories of your advance authorization, duties exempted under your advance authorization, including the notes, domestic procurement, everything is discussed. Everything is discussed. And friends, you have to also understand that when it is deemed exports, GST will be there. So I should have taken here, when it is deemed exports, one more difference is there. When it is deemed exports, one special point that I have to write: deemed exports, one special point, only one point was left out. Deemed exports, GST will be there, which can be asked as refund either by A Limited or Z Limited. So that we are discussing your GST. Deemed exports, A Limited will get the benefit of not paying import duty on his inputs and on his output sales, on his supplies. GST will be charged on his sales. A Limited will have to charge GST, but that GST can be refunded either by the supplier A Limited or by the recipient Z Limited. So if you look at A Limited, the deemed exporter, A Limited is a deemed exporter. On his inward supplies, inputs, he is not paying import duty, but he is paying IGST and compensation cess, he can take the credit. On his output GST, when he is supplying to Z Limited, there will be output GST, CGST, SGST or IGST as the case may be. Right, GST will be charged, but that GST can be asked as refund either by the supplier A Limited or by the recipient Z Limited. So that is another difference. That is another minute difference. So that also we have to remember. Right, now friends, we are done with your advance authorization. One special point is there in advance authorization. Rather than going for advance authorization and having a full-fledged export obligation, a special person can apply for annual advance authorization requirement. Annual advance authorization requirement. So the last point of your advance authorization, you have a special concept of annual advance authorization. Annual advance authorization. It is very similar to your advance authorization. The only thing is, annual advance authorization will be given to you in special cases. First, annual advance authorization is only when you are going by standard input output norms. So only if an item is having standard input output norms. Second, you should have your export performance. You should be a big exporter. Export performance in the 2 preceding financial years. In the 2 preceding financial years. Right. Third, friends, they are not going to ask how much export order you have, etc. What is the benefit of your annual advance authorization? They are not going, the DGFT is not going to check whether you have any export order or not. So DGFT will not check, your DGFT will not check whether you have export orders in hand or not. So that criteria will not be checked by DGFT. You are already a big exporter, you have proved your export performance in your preceding 2 financial years, your annual advance authorization will be given. And what will be the annual advance authorization value? This annual advance authorization value, the value of annual advance authorization, the value of annual advance authorization. Friends, when you talk about this value of annual advance authorization, you are talking about that value will be talking about how much import duty is exempted. How much import duty is exempted. So that value will symbolize how much import duty is exempted. Will be lower of, rather will be not lower of, will be higher of 1 crore or 300% of FOB value of exports of previous financial year. So certain important points that you have to remember. First, annual advance authorization is when? Only when you are having standard input output norms for a particular input and output. Only when the exporter is having export performance in 2 preceding financial years. And friends, the value of annual advance authorization, what represents the value of annual advance authorization? Whatever is the value in advance authorization, that much import duty you need not pay. That much import duty you need not pay. It is higher of. It is higher of 1 CR or 300% of FOB value of previous financial year, not average and all, of previous financial year. So that is all about your annual advance authorization concept, right? So can everyone go for annual advance authorization? No. Only when your standard input output norm is there, and it only when you are going by standard input output norm, you are not going by ad hoc or self declaration basis. Only when there is export performance in the preceding 2 financial years. And what will be the value? Higher of 1 crore or 300%. 300% of both your FOB value for actual exports and FOR value for deemed exports in the preceding financial year. Now, there are questions which are asked by ICI for your annual advance authorization requirement. What is the special point for your all other points of advance authorization is equally applicable for your annual advance authorization. Even your export obligation has to prove, except same, exactly the same. The only special point here is DGFT will not ask questions, okay, how much exports you are going to have, based on which we are going to issue you advance authorization. That questions will not be raised. That questions will not be raised because you already proved your export performance, right? So compute the annual advance authorization requirement, advance authorization for annual requirement for an exporter having export performance during the last 5 years. So has he proved the condition? Yes. Last 5 years. What is required is your export performance should be there in last 2 years. He has proved for last 5 years. The last financial year, the physical exports was 50 lakhs and deemed exports, FOR value was 10 lakhs. So what is the actual export value? 300% of FOB value of actual exports and FOR value of deemed exports. 50 lakhs plus 10 lakhs, 60 lakhs, or 1 CR, whichever is higher. So 300% of 60 lakhs will be 1.8 CR or 1 CR, whichever is higher. So you will get annual advance authorization. You will get duty free imports to the extent of CIF value of 1.8 CR. So import duty on your import value up to 1.8 CR will be exempted. So this 1.8 CR worth goods, when you are importing goods worth 1.8 CR, on those goods import duty will be exempted. It is reverse working, right? Advance authorization on annual requirement. So that is all, everything about your annual authorization, friends. Now friends, when you talk about duty free import authorization, friends, duty free import authorization is a twin brother of advance authorization. We are done with the advance authorization. All the aspects, small aspects we have completed. Even the smallest point which has never been asked by ICI, but which you have to remember because MCQs are there. Even the smallest point we have discussed about your advance authorization. Now what is duty free import authorization? Duty free import authorization is a twin brother of your advance authorization. The benefit is only for your inputs, not paying import duty on your inputs. Same, exactly the same. But what is different is when you talk about advance authorization, you import the goods without payment of import duty with the promise of export obligation. Here you first prove your export performance, then based on export performance you get duty free import authorization, then on the basis of that you import the goods free of duty. It is reverse. If I were to explain in a very simple way, sequence. The sequence is ulta. sequence is ulta. When you talk about your advance authorization, you first take advance authorization, import the inputs, and promise that you are going to have export obligation. You promise that first you import the inputs, then you manufacture it, then you export it. This is the sequence. And when you are importing the inputs, you are not paying import duty with a promise or an obligation that you are going to have export obligation. You are going to have export obligation. So first you don't pay import duty, but with the undertaking that you are not going to have export obligation. Therefore, you have to execute a bond or bank guarantee, because you are promising something which you are going to fulfill later. Now, this is all about your advance authorization in a very simple way. Advance authorization. Now, duty free import authorization. Duty free import authorization works in a very different way. First, you make an application for duty free import authorization. You prove your exports. Then for the further manufacturing and exports, you go for your duty free import authorization. Then you import the inputs. After you prove your exports, you get duty free import authorization, and thereafter you import the inputs. Because you have already proved. First you prove your exports. You make application for duty free import authorization before you export, but you prove your exports. You wait for exports. You import the materials on payment of import duty, claim duty drawback. You prove your exports. Then after that you get your duty free import authorization. Then you import the inputs without payment of import duty against duty free import authorization. This was against advance authorization. Right. Now friends, as you have already proved your exports, there is no export obligation attached. When there is no export obligation, friends, there is no requirement of any bond or bank guarantee. Now friends, the sequence is ulta. Here you promise that you are going to manufacture and export a lot. Therefore, with that promise, what you do, you import the inputs without paying import duty on a promise that you are going to have exports, huge exports in future. You import it now, you are promising that you are going to have huge exports in future, export obligation. And that being the case, friends, your exports will happen in future, and for that you are promising something. You may not fulfill your promise. Therefore, you have to execute a bond or bank guarantee. Whereas when you talk about your duty free import authorization, what happens is you make an application for duty free import authorization before, but you first prove your exports. You import inputs without any advance authorization or without any benefit. You pay import duty. When you export, you claim duty drawback. You go under duty drawback. For the old imports, you go for duty drawback. First you prove your export performance, then you get your duty free import authorization, then you actually import your inputs which will be used for future. So first you prove your export performance, only in future you will be getting the benefit of not paying import duty. So here it is ulta, sequence is ulta, right? First you prove your export performance, get duty free import authorization, then you import the inputs which are going to be used further in future, right, without paying any import duty, which is under duty free import authorization. There is no export obligation because you have already proved your exports. Based on your old exports, you are getting duty free import authorization, right? When there is no export obligation, there is no need of any bond or bank guarantee. The sequence is entirely ulta. Right? If you look at the sequence that we have discussed, when you discuss the sequence of your advance authorization, if you remember, there were totally 9 steps in which we have discussed the sequence. First, you make an application for advance authorization. When you're talking about your advance authorization, first you make an application for your advance authorization, then you get your advance authorization and you execute a bond or bank guarantee with your customs. You get advance authorization from your DGFT, right? Then you make a import of goods within 12 months from the date of advance authorization, and you promise export your exports within 18 months from the date of issuance of advance authorization, right? Finally, when you prove your exports, you update this export obligations with your DGFT, and DGFT friends will give you export obligation discharge certificate. Export obligation discharge certificate. You intimate this export obligation, and the customs will cancel the bond or bank guarantee that we have discussed. Now friends, what happens here is, first you apply for your duty free import authorization before making exports, before starting exports, because first you have to prove your export performance, and thereafter you do your exports within 12 months from the date of filing the application for DFIA, that is duty free import authorization, and getting a file number. And while doing all such exports, you shall indicate the file number or the application number on the export documentation. After you do your exports, you actually ask for duty free import authorization, right? Within how much time? Within 12 months from the date of export, or within 6 months from the date of realization of export proceeds, whichever is later. You ask for it, then you get it, and you use your duty free import authorization, whose validity is also same 12 months. Within, you can use this duty free import authorization to import the inputs without duty within 12 months. So validity is same 12 months. Advance authorization also you have to import it within 12 months without import duty. Duty free import authorization also you have to import within 12 months from the issuance of duty free import authorization. So if you look at the sequence is actually ulta, very ulta. Here exporter applies for exporter. If you're talking about your advance authorization or duty free import authorization, the sequence is actually ulta. Here exporter first applies for advance authorization with DGFT. So first application is made to DGFT for your advance authorization. Application is made, then you get advance authorization. After getting advance authorization, then you give bond or bank guarantee. First you are making application to DGFT. Application to DGFT. Then you get advance authorization. Friends, thereafter you give bond or bank guarantee to customs. Thereafter you import the inputs. Import the inputs without payment of import duty within 12 months of issuance of advance authorization. And thereafter you have to fulfill your export obligation. Export obligation within 18 months of, not from the date of import, 18 months from the date of issuance of advance authorization. And finally you intimate that you have fulfilled, you have reached your export obligation, right, to DGFT. DGFT gives you export obligation discharge certificate, which will be even transferred to your, given to your customs, and your customs will cancel the bond or the bank guarantee. So these are the steps. These were the steps which we have discussed in 3 parts of your advance authorization. Your duty free import authorization works in a different way. First you make an application for your duty free import authorization before export. So first step is same, application for duty free import authorization to DGFT before exports, right? Before exports you have to submit that, and you get an online file number. Then friends, you have to make exports within 12 months of that application. You actually export, and on all the export documents you mention the file number. So this is the first step. First you make an application that I intend to go for duty free import authorization to DGFT. you'll get a file number, and after that you export within 12 months from the date of that file number, and you mention for each export, every time you export you mention the file number on all the export documentation, right? That is the first step. Thereafter friends, then you tell that okay, I have fulfilled, I have first proved my export performance, now give me your, now actually you will be getting duty free import authorization. You are not getting duty free import authorization till now. Now actually you will be getting duty free import authorization now, where in the second step, after you have reached your after you have made your exports, and thereafter you will apply for your duty free import authorization. So now you are going to get your duty free import authorization, for which again you have to apply within 12 months of export or 6 months plus extension of realization of export proceeds, whichever is later. So again you are going to make application. So first application is your intention. First application is here about your intention for DFA. Next application is actually for getting your duty free import authorization. Within how much time you have to apply? Within 12 months from the date of exports or 6 months from the date of realization of export proceeds, whichever is later, after you export, right? And that export should have been completed within that 12 months time from your intention, right? And after you get, friends, after you get this duty free, you are going to get your duty free import authorization now. You are going to get your duty free import authorization now. First you have given your intention, I have to use different shade. Then you again will make an application. Now this time application to DGFT is made for actually getting this duty free import authorization, which is within 12 months from the date of export or 6 months from the date of realization of export proceeds, whichever is later. And then friends, you get your duty free import authorization, actually you get in hand. And after you get your duty free import authorization, you have to import the inputs within 12 months from the date of issuance of duty free import authorization. 12 months from the issuance of duty free import authorization. So that, friends, you have to understand. Obviously your realization, then you further export should also be getting you only foreign currency. This is the process. Here you find that there is no bond or bank guarantee. You will not find any bond or bank guarantee in duty free import authorization. And another difference, friends, you have to understand that this advance authorization is not transferable. It is based on actual user condition. Only you can use that. Only the person who is getting that advance authorization should use that input. So it is not transferable. Whereas your duty free import authorization is a transferable item. It is a transferable script. It works just like your MEIS script and SCIS script that we have discussed, right? There are other differences also, but the main thing was in advance authorization you import without import duty with the promise that you are going to export so much value and so much quantity, export obligation. Here you first prove your export performance, then you get duty free import authorization. No need to prove your export obligation. There is no export obligation. When there is an export obligation, you have to execute a bond or bank guarantee. When there is no export obligation, there is no bond or bank guarantee, because the sequence is ulta. The sequence is entirely ulta. So that, friends, you have to understand. But one thing is common in both the places. You have to use your advance authorization to import the inputs within 12 months from the date of issuance of advance authorization, and you have to use your duty free import authorization to import the inputs without payment of import duty within 12 months from the date of issuance of duty free import authorization. So usage of that should be within 12 months. Here there is no export obligation. So I have not written anything about export obligation. There is no export obligation. When there is no export obligation, there is no bond or bank guarantee. I have not spoken anything about the same, right? So when there is no export obligation, there is no bond or bank guarantee. In the previous case, advance authorization, there is an export obligation for which you have to give bond or bank guarantee. So you have to understand the sequence. Sequence is very important, right? Now, friends, let us see the other small differences and complete this. A repeatedly asked question. Your advance authorization, friends, is not transferable. Actual user condition, duty free import authorization is transferable. The validation that is required in advance authorization generally is 15% for your exam questions. 15%. 50% is for T. Normally it is 15%. Whereas duty free import authorization, they expect validation of 20%. They expect validation of 20%. It's not 15%, it's 20%. After removing that 20%, only for that value you will get duty free import authorization. So here they expect exports in future. So validation will be there in future export obligation. Here there is no export obligation. So whatever exports you have performed, based on that they will do reverse calculation and they will give you duty free import authorization. And when they do reverse calculation, they will remove that 20%. They will remove that 20%. Now advance authorization is up there whether there is standard input output norms without actual user condition, or standard input norms with actual user condition, or there is no standard input norms. So in all the cases you can go for advance authorization, but duty free import authorization is available only when there is standard input output norms and without actual user condition. So when you talk about your duty free import authorization, there should be standard input output norms and there should not be any actual user condition, because it is transferable. So in the other two cases where there is standard input output norms but with actual user condition, you cannot go for duty free import authorization. Where there is no standard input output norms fixed for a particular input and output category, you cannot go for duty free import authorization. So when you talk about the categorization, advance authorization is very broad. It is available whether there is standard input output norms without actual user condition, or whether there is standard input output norms with actual user condition, or there is no standard input output norms, you can go for ad hoc norms. So in all these three cases you can go for advance authorization, but duty free import authorization is very narrow, restricted. You can go for duty free import authorization only if there is standard input output norms plus no actual user condition, because it is transferable. That is standard input output norms plus there is no actual user condition, without actual user condition. Now when you talk about your advance authorization, it is there for your gems and jewelry sector as well as for your other sectors. Whereas your duty free import authorization is there only for other sectors, it is not there for your gems and jewelry sector. They don't have the benefit of duty free import authorization, right? And friends, the last point, when you talk about exemption from duties, when you go for advance authorization, actual exports, I am not talking about deemed exports, you get the benefit of your basic customs duties and other customs duties. Also you get the benefit of not paying IGST and compensation cess up to 31st of March 2021. Whereas in duty free import authorization, you get the benefit of only BCD. Only BCD is exempted. Only your basic customs duty is exempted in duty free import authorization. All the other customs duties including IGS and compensation cess are payable. Only BCD is relaxed. All the other customs duties including social welfare surcharge, anti-dumping duty, safeguard duty, anti-subsidizing duty, protective duty, IGST compensation cess are payable. So these are procedural part. When this question is asked in exam, don't write the procedural part differences. That is not expected because the number of marks will be only 3 or 4. You have to write all the earlier differences. Friends, if you look at it carefully, what are the differences? Simple differences. Your advance authorization is not transferable. Only you have to fulfill the condition. It's not transferable. Only you have to fulfill the export obligation. You cannot transfer it to someone else. Whereas your duty free import authorization is just like your MEIS script, SEIS script, it is transferable. You can get it, you can transfer it to someone else, you can sell it, right? When you talk about your advance authorization, it is available, the minimum validation criteria that is required for advance authorization is 15%, which means export obligation is import value plus 15%. Whereas your duty free import authorization is reverse. First you prove your export performance, then you are talking about your import, right? But the import value will be worked out reversely with the validation keeping in mind 20%. Now advance authorization is very broad. It is available whether there is standard input output norms with actual user condition or without actual user condition, or no standard input output norms. It is available for your gems and jewelry sector, for other sector. whereas your duty free import authorization is available only and only if there is standard input output norms, there is no actual user condition, and you're not talking about gems and jewelry sector. For other sectors it is available. For other sectors, when there is standard input output norms plus when there is no actual user condition. And the last point, when you talk about your advance authorization, especially when you're talking about your actual exports, all your customs duties are exempted, including IGST and compensation cess, which are exempted up to 31st of March 2021. Your IGST and compensation cess are exempted only up to 31st of March 2021. Other customs duties are always exempted. When you talk about your duty free import authorization, only BCD is exempted. All other customs duties, including your social welfare surcharge, protective duty, protective duty is treated as BCD for all practical purposes. So let us forget about it. Your social welfare surcharge, your anti-dumping duty, safeguard duty, anti-subsidizing duty, including IGST and compensation cess are payable. So that, friends, you have to understand. Friends, this completes our entire discussion about your advance authorization and your duty-free import authorization. That is your chapter 4 of your foreign trade policy and handbook of procedures volume 1.